Welcome to the Mortgage Rate Weekly Market Update for the week of January 29th, 2018. Hello, I'm John Thomas with Prime Residential Mortgage. We give you an update. Well, last week, mortgage rates again moved higher. If you take a look at the bond chart on the screen, you can see mortgage bonds have really been just selling off since about the beginning of December. They've hit some points where they try to stabilize, but they just keep breaking through floor of support, as you can see there. Another floor of support. Another floor of support, and then last Friday, if you look, you see that red candle, they broke through another floor of support. And this week they're probably going to gap down when they open up, because since they broke that floor of support, the bonds are going to fall lower. Now, as mortgage bonds sell off, moves mortgage interest rates higher. So with no floor of support stabilizing, stock market's been rallying. Weaker dollar is also affecting mortgage rates. If we have a weak dollar, that's going to make our interest rates have to push higher to compensate for a weak dollar for foreign investors. Because if they invest here and get a better yield, but when they convert it back, if they lose money because the dollar's weak, they lost the yield. So we have to pay a higher yield to get those dollars. So that's going to force mortgage rates higher as well. So with that in mind, with the big headwind for the bond market, all the technicals going on, we're going to recommend locking your mortgage rate until the bond market can stabilize and we can see it bounce off some kind of support and stabilize. So go ahead and lock your rate to start the week. If we dig into economic news, we saw the first reading of the fourth quarter gross domestic product for 2017 was released, and that came out at 2.6%, slightly below expectation, 2.9%, and that was a drop from the third quarter final reading of 3.2%. So now in that report, the DDP showed that personal spending was up 3.8%, and residential construction was up 11.6%. But offsetting that, we had a decline in trade and inventories. So we saw the GDP actually drop from third quarter to fourth quarter in the first reading. Then a weekly initial jobless claims came out on Thursday. Claims moved up 17,000 claims to 233,000 claims for the week. This number is still very good. It's well below the 300,000 mark. When you hit 300,000 or higher, that's signaling a bad labor market. So we still got a very good labor market in terms of weekly initial jobless claims. And they also revised last week's claims lower from 220 down to 216,000 claims. That's an important week because that last week of 216 is the sample week to be used in the January jobs report. So that's pointing to a strong jobs report for January, which again could help the stock market rally, which will pull more money out of the bond market. So if we're going to have a good jobs report, that's another reason to lock your rate, because that could move interest rates higher as well. In housing news, couple reports. We saw new home sales for December 2017, which measures signed contracts on new homes for sale, were down 9.3% to an annual rate of 625,000. The market was expecting a drop in new home sales of only 7.2%. But November new home sales were revised lower from 733 to 689,000. But November's number was still the best number in 10 years, so you would expect a pullback, and you do expect pullbacks in the winter months. So all in all, new home construction is doing very well. If you look at it on a year-to-year basis, we're 14.1% higher than we were a year ago. So new construction doing very well. Even though on the surface the report could look bad, still a great report. New home construction still doing very well. Then we saw existing home sales for December 2017 were down 3.6% to 5.57 million units. This is coming off the best number in 11 years for November. So again, a pullback was expected. Inventory of homes for sale remains tight. So we're still a seller's market and will be for the rest of the year. So that's important when you're out there shopping. It is a seller's market. There's going to be price competition on the house. So trying to lowball is not going to work. Now, housing inventory nationally dropped 10.3% on a year-to-year basis in December. It was the 31st consecutive month of inventory dropping. That's why it's such a strong seller's market. The tight inventory also has pushed home prices up. Nationally, home prices were up 5.8% on an annualized basis, and the national home price average price was moved up to $246,800. So we've got a good housing market. It's just tough for the buyers because of the tight inventory. We don't see that changing anytime soon. In the local news, we got first-time home buyer seminar. The next one is coming up in Newark, Delaware on Saturday, February 10th from 10 a.m. to noon at the Christiana Hilton Hotel. And then we got one coming up in Wilmington, Delaware. That's Wednesday, February 21st from 6 p.m. to 8 p.m., and that's at the Independence Mall on Route 202. You can register for either one of those events or give us a call in the office, 302-703-0727, or online, www.delawarehomebuyerSeminar.com. Look forward to seeing you guys next week.